Right now, international shipping lanes are basically under military fire. Mortgage rates are virtually freezing the entire U.S. housing market. And consumers, well, they're increasingly tapped out just trying to buy regular groceries.
Yeah, they really are.
By all historical logic, I mean, the stock market should be in an absolute freefall. But instead, we're looking at a dashboard today, July 9, 2026, where tech companies are just surging to astronomical valuations and indices are pushing record highs. So welcome to the deep dive.
Glad to be here.
We've got a really fascinating one today for you. We are looking at a system that is profoundly contradictory, and we are going to figure out how this split-screen reality is actually functioning.
It is the defining economic mystery of the moment, honestly. You have the physical economy, right? The world of oil, housing, actual physical goods, and it's just buckling under severe stress.
Right, heavy stress.
Exactly. And right alongside it, you have this digital economy, specifically semiconductors and artificial intelligence, behaving as if we are in, the most prosperous peacetime expansion in human history.
Okay, let's unpack this, because the cognitive dissonance here is just staggering. To figure out why the market is basically ignoring what seems like macroeconomic gravity, we're pulling data today from a big stack of fresh reporting.
Lots to go through.
Yeah, we've got BNN Bloomberg and Global Banking and Finance Review for the market moves, Zacks and TD Economics for the hard numbers on housing and jobs, and the Seoul Economic Daily for some really crucial central bank and overseas tech insights.
I should note, too, a couple of those sources were protected behind security walls, so we're just keeping our focus strictly on the accessible data for this discussion.
Makes sense. So let's start with the immediate catalyst on the physical side of this equation. We have an escalating military conflict in the Middle East, directly involving the United States and Iran, and it is sending absolute shockwaves through the energy market.
The chain of events over the last few days has been incredibly rapid.
Quick disclaimer for you, before we get into the details, we have to explicitly state that we are not taking sides or endorsing any political or military viewpoints regarding this U.S.-Iran conflict. We are strictly analyzing the factual events as reported in these sources, just to understand their market impact.
Exactly. We're just looking at the financial mechanics here. So, based on the reporting, the U.S. conducted military strikes on Iranian sites for a second day, and Iran retaliated by striking U.S. bases in the Gulf and firing missiles toward troops in Kuwait.
Which is a major escalation.
Huge. And U.S. President Donald Trump publicly stated that the interim deal with Iran, along with further talks to end the war, are, quote-unquote, over.
And as anyone who follows energy markets knows, anytime missiles are flying anywhere near the Persian Gulf, the algorithms that drive oil trading just immediately start calculating the threat to the Strait of Hormuz.
They price it in instantly.
Exactly. And that's exactly what we saw initially. Brent crude jumped nearly 10% over 3 days. But here is where the mechanics of this get really weird.
Yeah.
And where I kind of want to challenge the standard narrative.
Okay, go for it.
After that massive 10% spike, prices suddenly eased back down 2.2%. They dropped to $76.30 a barrel the very next day. I mean, treaties are collapsing, missiles are actively in the air, and yet the oil market effectively shrugged and cooled off.
Yeah.
It feels like the market has the attention span of a goldfish, honestly.
Well, it didn't shrug. It recalibrated based on a very specific set of parameters. What's fascinating here is how ruthlessly algorithmic trading parses political rhetoric.
Oh, interesting.
Yeah, the 10% spike, that was the market pricing in tail risk, the absolute worst-case scenario of a protracted multi-year regional war that completely severs the daily flow of oil through the strait.
Right.
But the algorithms caught another specific phrase from President Trump in that exact same statement. He mentioned that the recent fighting would not result in long-term military action.
Wait, really? So algorithmic trading models are just parsing presidential statements in real time, waiting for the phrase "not long-term," and using that to instantly short the oil spike they literally just created.
They're weighing probabilities, yeah. The market deeply understands the difference between a short-term kinetic event and a long-term structural disruption. I mean, the Strait of Hormuz is the ultimate global choke point.
It's massively important.
Roughly 20% of the world's daily oil consumption floats through a waterway that is, only 21 miles wide at its narrowest point?
Yeah, something like that.
But actual sustained blockages of the strait almost never happen. Even during the height of the tanker war back in the 1980s, the oil largely kept flowing.
Because shutting it down completely is basically a suicide pact for the economies of the producing nations themselves, right?
Precisely the game theory at play. A full blockade creates massive inflation for Western consumers, sure, but it simultaneously cuts off the primary revenue source for the Gulf nations involved in the conflict. It's an economic doomsday machine.
Right. Nobody wins.
Nobody. So when the market hears rhetoric suggesting an off-ramp, a signal that the action is punitive but not long-term, the risk premium on a barrel of oil compresses almost immediately. They know that, currently, shipping is still transiting the strait, albeit at reduced volumes.
I mean, that compression might make sense on a trading floor in New York, but that initial 10% volatility still leaves a massive crater in the actual economy for you and me. The sources point out that U.S. regular gasoline hit $3.85 a gallon, which is up 68 cents from a year earlier.
That's a huge jump for the average driver.
It really is. Think about your last trip to the gas station. That 68-cent year-over-year jump isn't some abstract trading probability. That is a direct tax on the consumer. And it doesn't just stay at the pump either.
No, it bleeds into everything.
Exactly. It hits the balance sheet of every trucking company, every airline, every agricultural producer.
Which brings us directly to the inflation data, because that 68-cent energy tax is violently colliding with consumer psychology right now. Well, the latest New York Fed survey shows U.S. consumer one-year inflation expectations just hit a three-year high of 3.7%. That's the highest it's been since September 2023.
Wow.
And more worryingly, the three-year expectations hit 3.3%, which is the highest since June 2022.
I really want to dig into those mechanics for a second. Why does the Federal Reserve care so much about what consumers, just average people, expect inflation to be 3 years from now, rather than just looking at what things actually cost today?
Because inflation is fundamentally a behavioral phenomenon. It's driven entirely by expectations.
Okay, keep going.
If a broad swath of the population genuinely believes that a car, a house, or even a gallon of milk is going to be significantly more expensive in 2029, their behavior changes today.
They buy it now instead.
Exactly. Or workers go to their employers and demand higher wages to front-run that anticipated cost of living. Then businesses, anticipating those higher labor and energy costs, proactively raise the prices of their goods. The expectation actually creates the inflation.
It's a self-fulfilling prophecy.
Totally. When three-year expectations anchor at 3.3%, it signals that the public is losing faith in the central bank's ability to force inflation back down to its traditional 2% mandate.
And the bond market is screaming that exact same lack of faith right now. We are seeing global bond yields just spike aggressively. Japan's 10-year yield just hit a 30-year high of 2.885%.
That's a staggering number for Japan.
It really is. Just to put this in perspective for you, Japan has spent the better part of the last 30 years actively fighting deflation. They pioneered zero interest rates and yield curve control just to try and get any inflation at all.
Right, they were desperate for it.
So for their 10-year yield to hit a 30-year high, that means the tectonic plates of global finance are seriously shifting.
It's a massive structural change. When bond yields rise, it mathematically means bond prices are falling. Investors are aggressively selling off Japanese debt because they are demanding a higher rate of return to lend their money.
Why are they demanding that now, though?
Because they are terrified that sticky structural inflation is going to just eat away the real value of their returns over the next decade. And this doesn't stay contained in Japan either.
The ripple effect.
Yeah, the Japanese have historically been massive buyers of U.S. treasuries. If they can suddenly get almost 3% at home, they repatriate that capital.
Which drains liquidity from the U.S. market, putting upward pressure on our own yields. I mean, the U.S. 10-year Treasury yield has been fluctuating right around 4.53%.
And this is where the central bank dilemma becomes really acute. The market is looking at $3.85 gas, they're looking at 3.7% inflation expectations, and looking at rising yields.
That's a lot of pressure.
It is, and they are betting the Federal Reserve is going to be forced into action. The data from our sources indicates Fed funds futures are currently implying 38 basis points of rate hikes this year.
Okay, let's break down what that 38 basis points actually means mechanically for folks who don't trade derivatives.
Sure, so the Fed moves in increments of 25 basis points, or 0.25%. By pricing in 38 basis points, traders in the derivatives market are placing hard capital on the absolute certainty of at least one rate hike.
Right.
And there's roughly a 50% probability of a second one before the year is out. They are betting that the Fed simply cannot sit on its hands while energy shocks ripple through the supply chain.
But the Fed is sending incredibly mixed signals here. I mean, on one hand, you have New York Fed President John Williams publicly stating he remains optimistic about short-term inflation, and he's explicitly citing an expectation that energy prices will eventually fall.
Yeah, he's looking at the models.
But then on the other hand, the Federal Open Market Committee, the actual body that sets interest rates, just agreed to completely scrap forward guidance.
This raises an important question about central bank credibility in an era of constant supply shocks.
Yeah, what's going on there?
Well, for the last 15 years, essentially since the Great Financial Crisis, we have lived in the era of forward guidance.
It was the standard.
Absolutely. The Fed would act like a GPS, telling markets, we are going to keep rates near zero until unemployment hits this exact metric, or we will hike rates 3 times next year. It was specifically designed to suppress market volatility by removing uncertainty.
Wait, so the Fed is scrapping forward guidance. That's like a pilot announcing to the passengers that they're throwing the plane's GPS out the window because the weather's too cloudy. I mean, should you and I be panicked if we're institutional investors trying to allocate billions in capital? I need that roadmap.
You need a roadmap, definitely, but the Fed realized the map they were handing you was constantly leading you off a cliff.
How so?
Forward guidance only works in a demand-driven economic cycle where the central bank actually has control over the variables. We are currently in a supply-driven cycle.
They can't print oil.
Exactly. The Fed has absolutely no control over Iranian missiles, Taiwanese semiconductor fabrication, or global shipping container availability. If the Fed uses forward guidance to promise a rate cut in 6 months, and then an energy shock sends oil to $100 a barrel, they are trapped in a totally no-win scenario.
Because if they follow through on the cut, they pour gasoline on the inflation fire. But if they break their promise and hold rates, they destroy their credibility with the market.
Exactly. So by scrapping forward guidance entirely, they are reverting to pure data dependency, much like the Volcker era of the late 70s and early 80s.
Just reacting to the numbers as they come in.
Yeah, they are admitting that the macroeconomic environment is just too volatile to predict. They will adjust rates meeting by meeting, based purely on the incoming data.
Which leaves currency speculators playing a really high-stakes game of chicken. I mean, the U.S. dollar is holding steady against the yen at 162.48, which is just below a 40-year peak.
It's incredibly high.
It is. The currency markets are essentially waiting to see who blinks first. Is it the Federal Reserve's commitment to fighting inflation, or is it the global economy buckling under the pressure of these high rates?
And if we look at the data coming out of Main Street, there are severe signs of buckling. The macro environment of 4.5% Treasury yields directly translates into the micro environment of 6.5% mortgage rates, and it is actively paralyzing the U.S. consumer.
Yeah, the numbers on housing from TD Economics are genuinely grim. June existing home sales tumbled 2.4% month over month.
That's a sharp drop.
Very. That brings the annualized rate down to 4.09 million units, which completely missed the market expectation of 4.20 million. We are now looking at a pace of home sales that is roughly 25% below the pre-pandemic trend. The transaction volume has just evaporated.
It's really important to understand the mechanics of this freeze, though. It's not a housing crash in the traditional sense like we saw in 2008, where an oversupply of subprime inventory just flooded the market and crashed prices.
Right. This feels different.
It is. This is a liquidity freeze driven by the income-adjusted housing cost dilemma.
Because even though sales volume is plummeting, the median home price is actually still up 1.8% year over year. The asset isn't getting cheaper. It's just getting vastly more expensive to finance.
Right. Run the math on the affordability index. You have buyers facing a historically high asset price paired with a 6.5% 30-year fixed mortgage.
Math doesn't work.
It mathematically locks a massive demographic out of the buyer pool. Their income simply cannot support the monthly payment. But simultaneously, you have the seller side of the equation locked down by the golden handcuffs effect.
Oh, you mean the homeowners who refinanced in 2020 or 2021?
Yeah, exactly.
Yeah.
Millions of homeowners are sitting on 3% or 3.5% mortgages. Even if they want to move, to downsize, upsize, or relocate for a job, they cannot afford to sell their current home, give up that incredibly cheap debt, and take on a new mortgage at 6.5%.
So inventory stays artificially constrained, which keeps prices elevated even as demand plummets. The entire market is at a stalemate.
It's completely stuck.
And we are seeing severe regional fractures in this data, too. While national sales dropped, the Northeast actually saw a recovery, with sales up 2.1%. Meanwhile, the South dropped 3.6%, and the Midwest dropped 3.0%. That is a massive divergence in a single month's data.
If we connect this to the bigger picture of pandemic migration, though, it makes perfect sense.
Walk me through that.
The South and the Midwest, particularly Sunbelt cities, they saw explosive parabolic price growth, driven by remote workers fleeing high-cost coastal cities in 2020 and 2021. The affordability in those regions was completely destroyed in the span of 3 years.
They're just overheated?
Exactly. They have hit an absolute affordability wall. The Northeast, conversely, had a much softer start to the decade. It didn't experience the same manic influx of remote capital, so the price-to-income ratios there have a tiny bit more elasticity left.
Here's where the dashboard gets really confusing, though. Historically, if housing transactions drop 25% below trend, it means we are in a deep recession, construction is halted, and people are losing their jobs in droves.
That's the textbook reaction, yeah.
Right. But the later data completely contradicts that. Jobless claims are holding perfectly steady at 215,000. Continuing claims are at 1.814 million.
Which is incredibly low.
That is not just steady, it's actually lower than the 1.9 million average we saw back in 2025. People have jobs. The labor market is completely resilient.
The labor market is the final firewall. But having a job doesn't mean your purchasing power is intact. When wages grow at 4%, but your housing, energy, and food costs have compounded at double digits over 3 years, your discretionary income basically evaporates.
It's a hidden recession.
Exactly. And that exhaustion is finally showing up in the most inelastic of consumer behaviors.
We're talking about the PepsiCo earnings, right?
Yeah. Did you see those?
This was the most telling piece of data in the entire stack for me. PepsiCo reported their Q2 earnings, and on a headline basis, they looked great. They beat estimates with $2.20 earnings per share and brought in $24.18 billion in revenue.
Wall Street generally applauds that kind of headline.
They do. But when you dig into the segment data, their North American food and drink sales are actively weakening. The company explicitly cited tightening consumer budgets.
In behavioral economics, we look very closely at the elasticity of demand for consumer packaged goods.
Right.
Buying a house or a car is a highly elastic macro decision. Buying a bag of Doritos or Gatorade at a convenience store is a micro decision. It is historically incredibly inelastic. When consumers who are fully employed start actively cutting back on a $3 bag of chips, it is a glaring red warning light.
Here's where it gets really interesting, because jobless claims are fine. People have jobs, but they can't afford to buy a condo, and apparently they're cutting back on Doritos and Gatorade. It feels like the economy is this beautiful, shiny car, but the check engine light is blinking furiously.
It's the ultimate canary in the coal mine, honestly. It means the cumulative weight of that $3.85 gas and the rent increases has finally bled the consumer dry.
These have nothing left over.
Right. They aren't just trading down from premium brands to store brands anymore. They are exiting the transaction entirely. They are cutting out the snack aisle because the math on their monthly budget no longer works.
And if they're cutting out a $3 snack, what does that mean for larger discretionary purchases? I mean, this is why analysts are aggressively revising expectations for companies like Delta Airlines.
That Delta report is going to be crucial.
Delta is about to report, and they are coming off a massive 6-quarter streak of beating earnings. But the consensus expectation now is a staggering 28.57% drop in earnings per share year over year.
Because if a family is agonizing over the grocery bill, they have absolutely already canceled or downsized the summer vacation flight.
This is the first thing to go.
Exactly. You are looking at a consumer base that is employed but structurally exhausted. The velocity of money in the discretionary economy is slowing down rapidly.
Okay, let's pull all this together before we look at the other side of the screen. We have a geopolitical conflict threatening global shipping and keeping energy prices highly volatile. We have consumer inflation expectations, anchoring at 3-year highs, forcing bond yields to multi-decade peaks.
It's a lot of bad news.
It is. The housing market is completely paralyzed, and the employed consumer is so squeezed they are cutting out basic snacks and travel. Under any normal economic framework, the S&P 500 should be deeply in the red, pricing in a severe earnings recession.
The broader indices should absolutely be reflecting that pain, yes.
But they aren't. The S&P 500, the Dow Jones, the Nasdaq, they all rose today. They shook off the Middle East news in hours. So what does this all mean? We have a world on fire, but Wall Street is putting on noise-canceling headphones and blasting an AI megamix playlist. Is this a new industrial revolution that genuinely outweighs global conflict, or just the mother of all tech bubbles?
The semiconductor and AI narrative has reached a velocity that is essentially creating a parallel economy.
The numbers in the chip sector are staggering, and it's happening globally. In South Korea, SK Hynix, one of the premier memory chip makers, jumped 5.3% in a single day.
That's massive for a company that size.
Why? Because their U.S. share offering was oversubscribed more than 7 times. Think about the mechanics of that. In a world where capital is expensive and yields are at 4.5%, institutional investors demanded 7 times more equity in a chipmaker that was actually available.
They're desperate for exposure.
Exactly. In China, you have CXMT gearing up for a massive IPO, utilizing aggressive book building to lock in capital, despite global trade tensions.
We should explain that book building process, actually, because it really highlights the institutional frenzy here.
Yeah, please do.
When a company like CXMT goes public, the underwriters don't just guess the price. They take the prospectus to major institutional investors, pension funds, sovereign wealth funds, and ask them to submit bids for how many shares they want and at what price. In a high interest rate environment, IPO book building is usually pretty sluggish because capital has safer alternatives like those 4.5% treasuries we talked about. But in the semiconductor space right now, these books are being heavily oversubscribed at the very top of the price ranges. It is a blind scramble for exposure to compute power.
And it is driving the massive U.S. tech rally. Broadcom shares rose 4% today, which acted as a primary engine dragging the entire S&P 500 upward. Micron jumped 6.3%.
The momentum is unreal.
And Micron isn't just a speculative software play, right? They explicitly cited surging demand for memory in the AI era, and they're backing that up with physical infrastructure. They're currently building the largest semiconductor manufacturing site in U.S. history in central New York.
This is exactly why the Asian markets bought the dip so aggressively today. When the indices dropped on the initial news of the strikes in the Middle East, Japanese and South Korean funds immediately stepped in and bought the chipmaker.
They just swooped in.
Yeah, they viewed the geopolitical panic as a taco moment, a temporary correctable overreaction.
I mean, I understand the hype around artificial intelligence. We all see the chat bots and the generative video and how cool it is. But how can a single sector outweigh the macroeconomic drag of a paralyzed housing market and an exhausted consumer? How does Wall Street justify putting on those noise-canceling headphones to the real economy?
If we connect this to the bigger picture, it comes down to a fundamental belief. Wall Street believes that semiconductors are the new oil, and they are pricing in a century-defining paradigm shift.
It's a bold claim.
It is, but you have to look at the source of the capital. The capital flowing into housing, or PepsiCo, is retail capital. It depends on the wages and debt capacity of the average citizen.
Which we know is tapped out.
Exactly. But the capital flowing into Micron, Broadcom, and SK Hynix is corporate capital expenditure. It is purely B2B spending.
Ah, I see. So Micron does not care if the average family can't afford a $400,000 house or a vacation.
Not right now, no. Micron's customers are Microsoft, Google, Amazon, and Meta. These hyperscalers are engaged in a trillion-dollar arms race to build the underlying infrastructure of the AI economy.
They're just spending billions.
They are buying tens of thousands of GPUs, memory chips, and the massive data centers to house them. This corporate capital expenditure is entirely decoupled, in the short to medium term anyway, from the daily struggles of the consumer.
Right, because they have deep pockets.
Exactly. A tech giant with hundreds of billions in cash reserves does not alter its decade-long data center strategy just because U.S. gasoline hit $3.85.
It's like the railroad expansion of the 1800s, or the fiber optic cable build-out during the dot-com boom of the late 90s.
That's the perfect analogy.
The infrastructure has to be built, regardless of whether the end consumer use cases are fully profitable yet. But that historical comparison has a very dark underside, doesn't it?
Oh, absolutely.
Because the fiber optic build-out of the 90s resulted in a spectacular misallocation of capital and a massive market crash when the telecom companies realized they had laid millions of miles of cable that literally no one was using.
And that is the exact existential risk hanging over this current market. The BNN Bloomberg report touches on this underlying anxiety.
What are they saying?
The market is currently pricing in the absolute best-case scenario for AI, that it will definitively revolutionize global productivity, replace massive swaths of human labor costs, and generate enough corporate profit to justify these multi-billion-dollar semiconductor plants.
But if it doesn't? I mean, what if AI turns out to be incredibly useful for coding and writing emails, but completely fails to deliver the multi-trillion-dollar productivity miracle that actually justifies these astronomical valuations?
Then you have the mother of all capital misallocations. If the hyperscalers realize in, say, 2027 or 2028 that the revenue from AI software isn't covering the exorbitant costs of the chips and the energy required to run the data centers, they will abruptly slash their capital expenditure.
The spending just stops.
And the moment that B2B spending stops, the semiconductor rally collapses. And because semiconductors currently make up such a disproportionate weighting of the S&P 500, they would drag the entire index down to meet the reality of the struggling physical economy.
So what we are watching every single day in the markets is a violent, high-stakes tug of war. On one side, you have the macro drag, war, inflation, high yields, and a completely tapped-out consumer.
It's heavy.
And on the other side, you have AI euphoria and the bottomless capital expenditures of 5 massive tech giants. And right now, today, the euphoria side is just pulling harder.
It is entirely overriding the traditional warning lights.
This has been an incredibly complex web to untangle, but let's step back and look at the whole dashboard.
Good idea.
The data from July 9, 2026 perfectly encapsulates an economy split entirely in two. On one side of the screen, you have the physical, tangible world. It's a world where oil tankers are navigating active conflict zones in the Persian Gulf.
Real-world risks.
Yeah, it's a world of 6.5% mortgages, freezing real estate, $3.85 gasoline, and average people having to just put the potato chips back on the grocery shelf because 3 years of compounding inflation have completely decimated their paychecks.
Yeah.
That is a world weighed down heavily by economic gravity.
And right next to it, on the exact same dashboard, you have the digital realm. A world of book-building frenzies, next-generation memory chips, and artificial intelligence, all fueled by a corporate arms race that is propelling equity markets to new heights, completely defying that very same gravity.
We've seen today how the AI boom is effectively acting as a massive financial shock absorber, keeping the broader indices buoyant while the physical foundation of the economy really struggles.
It's the only thing holding it up.
But I want to leave you with a final, lingering thought to explore on your own. We know the physical and digital worlds aren't actually separate, right? They are deeply intertwined.
More than people realize.
AI doesn't run on air. It runs on physical servers, housed in physical buildings, powered by physical energy grids, and built with highly delicate supply chains. What happens to this resilient financial market if the AI boom faces a genuine, prolonged supply chain disruption? If the chips are the only things holding up this incredibly complex macroeconomic house of cards, what happens if the chips are down?
That is the absolute ultimate vulnerability in the system.
Thank you so much for joining us on this deep dive into the sources today. The global dashboard is throwing some seriously mixed signals, and the contradiction between the physical and digital economies is sharper than ever.
It's been wild to watch.
It really has. But understanding the mechanisms behind those signals, the algorithms, the yields, the corporate spending, that is your best advantage in navigating it. We will be right back here next time to dive into a brand new stack of sources. Keep digging.